Hi, in this video I'm going to take you few steps close to winning a Nobel Prize. There is a Nobel Prize in finance and accounting waiting for a person who's able to prove the ideal capital structure, which means what is the ideal and the best capital structure. Up till now, nobody has been able to prove. So in this video, I'm going to take you few steps closer to winning a Nobel Prize, where I will give you my insights and some pro tips relating to finding the optimal capital structure. Hi, I'm the Commerce Specialist. Welcome to my channel, where you'll find videos covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. In this video, I'm not going to tell you what is the best capital structure. In fact, I'm going to teach you how to find the optimal capital structure, which is very close to the best capital structure. So before we get into the discussion of what is the optimal capital structure, everybody should know what is capital structure. So this is how I explain capital structure. You guys must have, everybody knows this formula. Total assets are equal to total debt plus total equity. Total debt means liability. So let's assume I have assets of 100 million. And this 100 million is financed, let's say 70 million from debts and 30 million from equity. So if I take my total assets as 100%, so debt will be 70% and equity will be 30%. This debt and equity, the composition of debt and equity, is called capital structure. So in my total capital, whether it is debt or equity, 70% is debt, 30% is equity. So if I have 100 million of assets, how they are financed by? 70% has been financed by debt, 30% has been financed by equity. So what companies are struggling with these days is to find the best mix. Should debt be 60% or equity be 40%? Should equity be 60, debt be 40? Should this be 80, this should be 20? Should this be 20, this should be 80? And so on and so forth. So up till now, nobody has been able to prove what is the best mix when it comes to debt and equity. In this video, I'm going to explain you, looking at certain circumstances, what is the optimal mix. When I say optimal, I'm not saying it is the best, but it is close to the best. So to explain the concept, I have created a question here. It says, lucky company has no debt and preference stock in its capital structure at the moment, but the company wants to use debt to take advantage of low interest rates. Cost of debt at different debt levels are given below. So an experienced banker has given them these figures. If there is zero debt, cost of debt is still 7%. That means normally the base rate of debt is 7%. That is before tax. If debt is financed, if your assets are financed, if your total assets are financed 30% by debt, so the before tax cost of debt will be 8%. If the assets are financed 50% from debt, the cost of debt would be 9%. And then if it is 90%, the cost of debt would be 11%. Now if you see, the higher the percentage of debt in your total assets, the higher the cost. Why? Because higher the risk. So presence of debt in the capital structure is a clear indicator of risk. Presence of debt is also called the gearing level, the gearing percentage. Higher the debt, higher the gearing. Higher the gearing, higher the risk in the company. So additional information given to us is the risk-free rate is 6%, market risk premium is 7%, and the corporate tax rate is 31%. So risk-free rate is 6%, market risk premium is 7%, corporate tax rate is 31%. Since there is no debt at the moment, the unlevered beta or ungeared beta is 9%. Calculate optimal capital structure. As I said earlier, looking at certain variables which are given to us. So in the current circumstances, what can be our optimal capital structure? Let's see how it is done. So I'm copying here these percentages with debt. So this is weight of debt. Weight means the weightage in the capital structure. So if debt is 0%, okay, and before tax cost of debt is given as 7%. So it is, you can take 7% or 0.07, it's up to you. You can take it as 7%, no issues. So here I'm not doing anything new, I'm just copy pasting this. 30% would mean 0.3, and at 30% the cost is 8%. If the debt is financed 50%, which means 0.5, the cost of debt, before tax cost of debt would be 9%. And if it is financed by 70% debt, so the cost of debt will be 10%. 90% debt, which is 0.9, and the cost here says 11%. Now we need to understand that debt and equity, when we add debt and when we add equity, it should be 100, or you can take in terms of 1. So if debt is 0, equity is 1. 1 means 100%. If debt is 30%, equity will be 70%. If debt is 50, equity will be 50%. If debt is 70, equity should be 30%. If debt is 90, equity should be 10%. So when you add this, you will get 1. Total should always be 1. 1 plus 0 is 1. 0.7 plus 0.3 is 1. 0.5 and 0.5 1. 0.1 and 0.9 is 1. Debt equity ratio means debt divided by equity. So this will obviously be 0. 0.3 divided by 0.7 will give you 0.43. 0.5 divided by this will give you obviously 1. 0.7 divided by 0.3 will give you this. 0.9 divided by 0.1 will give you $9. So this is actually a percentage. Debt equity ratio 100%, 2.3, 9%. Now it says before tax cost of debt. This is before tax. For getting after tax cost of debt, KD is cost of debt. After tax, what you do is before tax cost of debt, you just multiply it by 1 minus tax rate. So 1 is in the formula. Tax rate here it says 31. So 1 minus 0.31. So all these amounts, 1 minus 0.31 will be 0.69. So 7% multiplied by 0.69, you will get an amount. 8% into 0.69, 9% into 0.69. Because before tax cost of debt, when you multiply by 1 minus tax, this is 1 minus tax, you will get after tax cost of debt. So all these numbers, when you multiply 1 by 0.69, you keep getting the value of after tax cost of debt. So you get 4.83, 5.52, 6.21, 6.90, 7.59. I repeat, before tax cost of debt, if you multiply by 1 minus tax, which is 1 minus 0.31, 0.31 is 31%, that means 0.69. So if you multiply 11% by 0.69, it will give you 7.59. Now we also need levered beta. Unlevered beta means ungeared beta is given to us. We want to find levered beta. I have already created a video on gearing and ungearing of beta. Gearing and ungearing means levered and unlevered beta, or you can also call them asset and equity beta. So you can watch this video, you will understand what is gearing and ungearing of beta. We have ungeared beta, unlevered or ungeared beta. We need levered or geared beta, and how to convert an unlevered beta to levered or levered to unlevered. Let's have a look at the formula, so that we can calculate cost of equity and later on weighted average cost of capital. So guys, levered beta means geared beta. Unlevered beta means ungeared beta. Here we need levered beta, and if you can see, levered beta is also called equity beta. To find equity beta, what we do is we take asset beta, which is ungeared beta, into 1 plus 1 minus tax into debt upon equity. So here if you look at, if there is no debt, so your unlevered beta will be 0.9. So even I am writing levered, but since there is no debt, that means it will be unlevered beta. Now coming to this one, when there is 30% debt, what would be the geared beta now? Because if there is debt, now the beta has to be levered. So levered beta is like this. Asset beta is 0.9, 1 is in the formula, plus 1 minus tax. Tax rate is 31% if you look at this. So this is 0.31 into, now what is the debt equity? If you multiply by 100, it will give you a percentage, but it is 0.43. So into 0.43. When you solve all this, your equity beta will come to 1.17. So your equity beta is coming to 1.17. Similarly, you go for this when debt is 50%. How much should be your levered beta? Levered beta means equity beta. So what you do is, you start with your geared beta, you start with your asset beta, and here you just have to change, instead of 0.43, you will be putting 1. So you will have your levered beta. When debt level is 0.7, you can use the same formula and use your debt equity ratio of 2.33. Put this here, everything else remains the same, and you keep getting the values. So I've calculated all the values for you. When debt is 0, your unlevered beta is 0.9. When debt increases to 30%, it becomes 1.17. And when debt becomes 50%, you have to calculate all this 3 times more. So for 50%, your levered beta is 1.52. For 70%, it is 2.35. For 90%, it will come to 6.49. So I'm not wasting time. Coming to cost of equity. Now, cost of equity, we can find through capital asset pricing model formula. And the formula is cost of equity is equal to risk-free rate plus beta into market risk minus risk-free rate. Now risk-free rate is given to us here as 6%. So 6% means 0.06 plus beta, which is 0.9. Now guys, remember, if you are given market risk, you minus risk-free rate, what you get is the risk premium. So in this question, market risk is not given. Instead, risk premium is given, 7%. Means when you minus these two, you should be getting 7%. Okay? Because market risk minus risk free is called risk premium. So risk premium is directly given. So when we solve this, we get cost of equity or investors required rate of return. You can also call it cost of equity, or you can also call it investors required rate of return, which will be 12.3%. So you will have cost of equity here 12.3%. Likewise, you can calculate cost of equity for all this. All you have to do is risk free will remain the same, risk premium will remain the same. You just have to change the value of beta and get different cost of equities. Guys, for your understanding, I've already created a video on capital asset pricing model where I have discussed this in detail. Actually, capital asset pricing model formula is used to calculate cost of equity, or you can call it investors required rate of return. So you can watch this video and you will understand more about capital asset pricing model. Here, all you need to remember is calculating the cost of equity. We have used capital asset pricing model. Some of the data was given to us, so we just plugged in the data and found this. And you can calculate cost of equity for various level of debt, okay, using your beta values. Here I've taken, if you see, I've taken 9. In the same formula, if you put 1.17, you'll get a different cost of equity. In the same formula, everything remains the same. Instead, you put 1.52, you'll get a different. So I'm just putting the values because I've already calculated. I'm saving time for you. These are the different cost of equities, or you can say investors required rate of return. One thing very important, if you notice, investors are not fools. If there is high risk, they will demand high returns. So if you notice, when there is no debt means zero gearing. Zero gearing means no risk. So investors are requiring a return of 12% if they invest in a project. When there is debt of 90%, means very high risk, they are asking 51% return. So investors like shareholders, they are not fools. If there is high risk, they are looking for higher reward. Higher reward in the form of return on their investments. So if you look at, if there is 90% debt, they are requiring 51% return on their investment. The last formula is WACC. We call it weighted average cost of capital. So formula of WACC is like this. Weighted average cost of capital is equal to cost of debt. Obviously, this is after tax cost of debt into weight of debt plus cost of equity into weight of equity. So for the first one, if you look at after tax cost of debt, it is 4.83. So I'm taking 4.83% into weight of debt 0 into 0 plus cost of equity is 12.3 into weight of equity is 1. So obviously this multiplied by 0 will become 0 and this become 12.3%. So weighted average cost of capital is 3.3%. So guys, if you notice, I've been very consistent for you. I have created a video on weighted average cost of capital where I have explained you in detail how to calculate weighted average cost of capital. So please watch this video. It will help you a lot. Here, one more important thing I want to tell you is that when we are calculating WACC, we are assuming that these are market value of equity and cost. Okay. So we never calculate weighted average cost of capital based on book values. We always take market value of equity and debt. So our assumption is that we have taken market value of equity and debt. So WACC is 12.3. Now here again, when you look at cost of debt for the second one, after tax cost of debt, when you take 5.52 here, take the weight of the debt, which is 0.3. Okay. So 5.52 is the cost of debt into the weight of debt is 0.3 plus cost of equity 14.6 into weight of equity, this is 0.7. When you solve this, add them, you will get WACC for this. Likewise, keep doing for all of them, you will get weighted average cost of capital. So let's see how much it comes to. So guys, if you notice, I have calculated the weighted average cost of capital looking at the weightage of debt and equity and the cost of debt and equity. So I got this. When I look the weight of debt and equity 50% and the cost of debt and equity, see, after tax cost of debt, after cost of equity, so you will get this, so on and so forth. Now comes the important part. We are trying to calculate the optimal capital structure. Not the best, but close to the best. And we are trying to calculate optimal capital structure looking at the variables which are given to us, like the gearing levels, the risk-free rates, the risk premium, the tax rate, so on and so forth. So the optimal capital structure is when your weighted average cost of capital is the minimum. Can you see here? Your weighted average cost of capital is the minimum here, 11.43. So let's come here. So it says 50-50. Looking at the given scenario, when the risk-free rate is 6%, risk premium is 7%, tax rate is 31%, unlevered beta was 0.9. So looking at all these different variables, at the moment, if our total assets are financed 50% by debt and 50% by equity, our weighted average cost of capital will be the lowest, and that is the optimal capital structure. I hope you have understood this. If you have any queries relating to this topic, please feel free to leave a comment. I will reply to you as usual. If you are not yet subscribed to my channel, please subscribe to my channel because it helps me to grow further. Don't forget to press the bell notification button so that you get my videos on a timely basis. If you like this video, please give me a thumbs up and share this video with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.